Good evening, everyone, and welcome to the Beginning Investors Group Online. I want to welcome all of our REIA members here tonight, as well as any guests that are attending. I really appreciate you guys coming out tonight. We are broadcasting the Beginning Investors Group out to at least 5 of our REIA groups, which is Atlanta REIA, Tampa REIA, Charlotte REIA, Savannah REIA, and Chattanooga REIA. But we're also broadcasting it to anybody who's listening tonight around the country or around the world. So we really appreciate you being here tonight for the Beginning Investors Group Online. This is an educational group for new investors who are just getting started in the business, as well as new again real estate investors who may have taken some time off from real estate investing and are getting back again. We appreciate you guys for being here too tonight. Every month we do this on the 4th Wednesday of each month at 7 p.m. Eastern time. We may be changing that schedule in the near future or adding some more dates. Also, we've been doing this event on GoToWebinar for quite some time, but we may be moving to a new provider called Zoom very soon. If we do, that will require you to register again for the Beginning Investor Group to get on our new list. Right now, you can subscribe once and attend all these GoToWebinar events for the Beginning Investor Group, but that will change if we go to a new provider. So I just want to give you guys a heads up that may be coming really soon. I'm excited tonight to have my good friend Paul Rossano here. Paul is an incredibly heart-centered fella, and his mission is to help transform people's lives financially, which is why he's here with us tonight. Paul spoke for our groups many times in the past, and we try to have him back every couple years. He started the world of real estate investing at the age of 21 and has been doing it for over 19 years and has done hundreds of transactions in both the single family space as well as the commercial side of the business. He's also started and ran several of his own successful business. Paul is also a trainer for George Antone's company, Finance. And you may have heard of George before. A lot of times you'll see me give out those books at our meetings called The Wealthy Code. Well, that's one of George's books. And Paul is one of George's top trainers. And he spoke at our groups and several times in the past and done workshops with us called The Wealthy Code. Well, this year he's back and doing a brand new event called the Passive Income Course, which he'll share a little bit with you tonight. But tonight, Paul is here to teach you how to structure deals for passive income like the top 1% of all investors out there. You know, we spend a lot of time talking about getting quick cash now through rehabbing or through wholesaling deals. Well, tonight, Paul's here to talk about something different, and that is to invest your time and effort into deals that will earn you money forever without you having to work for it anymore. So basically, you do the work once, and then whatever your investment is will pay you for a long time until you sell the asset. And you can make what we call mailbox money, passive income. So Paul, I'm really glad to have you here tonight. Welcome to the webinar.
Thank you so much, Dustin. Really appreciate it. Happy to be here.
Glad to have you here as well. And some of you may have seen Paul recently at a couple of our other REIA groups. He was up in Chattanooga recently, as well as Savannah, and he's going to be visiting Atlanta, Tampa, and Charlotte here real soon. If you stick around to the end of this webinar, I'll share some of those dates for you when Paul's going to be in town. So Paul, what I want to do right now is let everybody know that if they have any questions for you, they can send them in via the GoToWebinar interface. So if you have any questions for Paul throughout this webinar, send them in for the GoToWebinar interface. What he's going to do is every once in a while, he'll ask me if there's any questions, and then I will read them to him for you. Also, at the very end of the webinar, he's going to take some questions from you as well. So if you have questions, please, by all means, send them in. That's what we're here for, to help you get your questions answered. So Paul, what I want to do right now is turn the screen over to you.
I'm ready. Let's do it. Can you see me?
It's working for me.
So just wanted to show my webcam, show my face, show you where I am. I'm actually here in Charlotte, North Carolina right now. I live out in San Diego, but I'm here because I'll be speaking at Charlotte REIA tomorrow night. So I'm here in an Airbnb in Charlotte, and this is where I'm coming to you from tonight. I'm going to take my webcam off so I can go through my PowerPoint and so you can follow along the slides, because there's some incredibly important information on the slides I want you to be able to stay focused on. When I ask questions, which I'll chime in throughout the presentation, and anytime that I open it up for questions, I'll turn my webcam back on so you can see me and you can actually see my face. All right, so I'm going to turn my webcam off now, and we'll get going here with the presentation. Actually, before I do that, I really want to just acknowledge and thank Dustin. I know he works incredibly hard to bring all of us together, to bring all of you together. So I just can't thank you enough, Dustin, for the work that you do and how much you support your members and your communities, and just how much time and energy you put in. I'm incredibly grateful for who you are and for having me. Really just appreciate you. So thank you so much.
Man. They're like family to me. So are you.
I know they are. I really appreciate that. Okay, so I am going to turn my webcam off and let's get rocking and rolling here with the presentation. Okay, so as you see on the screen, the purpose of tonight is to teach you how to structure passive income deals like the top 1% of investors in the world. I have a ton of content to cover and a ton to share with you tonight, so I'm going to go through this relatively quickly. So do your best to follow along, take notes, and I'll chime in. Like I said, I'll open it up for questions at a few points throughout the presentation. So the objective of this training tonight is to open your eyes to the blueprint for structuring low-risk passive income deals for any income-producing asset that only the most sophisticated investors on the planet know. And I want to stress a couple of things here. So the blueprint, there is literally a blueprint for structuring every single deal you ever do for income. And that's what we're going to be diving into tonight. Low risk. This is the key. Low risk. I cannot stress that enough, how important making your deals low risk is. And this works for any income producing asset. So I know most of you are real estate investors. Real estate's a great cash flow producing asset, or can be. There are lots of other cash flow producing assets. This formula, this blueprint I'll be sharing with you works for any income producing asset. This is not specific to real estate. So why is this important? Let's talk about why this is important. So I want you to imagine a scenario. You imagine there are 4 friends, and these 4 friends, they buy identical rental properties next to each other. They all collect $1,000 a month in rent. So far, all identical, but there's going to be some different outcomes here. So investor A will lose the property within 2 years to foreclosure. Investor B will give up too soon and say real estate investing doesn't work. Investor C will be moving backwards financially when he thinks he's moving forward. So he'll be making money, but he's actually moving backwards financially. And he won't find out until he retires that this is the case. And investor D is the only one out of all 4 of these investors that is actually moving forward. So you have to ask yourself, what is the difference? What is the difference between these 4 investors? And these are real life scenarios that are happening all the time. And the difference is what we'll be diving into tonight, which is how to structure your deals correctly. That's it, folks. So the reality for most investors, now I get asked to speak all over the country and I travel all over the country and I'm speaking in front of investors constantly. I've spoken in front of thousands of investors. So I've met a lot of different investors all over the country. And I want to share a few different realities for you from the folks that I've connected with. So there's a lot of investors that really have nothing to show for their efforts. You know, they call themselves investors, but the truth is they're struggling. They're trying to figure it out. They're bouncing around from one thing to another with nothing to show for it. They're going deal to deal, just like an employee would go paycheck to paycheck. So, and the reason is because they don't know the blueprint, right? They don't know how to actually structure their deals correctly. People that are losing friends and family's money. So actually one guy that I met in Florida, this is an incredibly tragic story, but unfortunately this is happening all the time too. And I've shared this a number of times if you've seen me speak, but it's such a powerful example of what's happening out there. People raising money from friends and family. A guy, like I said, I met in Florida at an event a few years ago. This guy raised $1 million, all from friends and family, and lost it and all the properties within 2 years. Think about it for a second. How would that feel to be that guy? It's like, you know, the holidays and Thanksgiving, like that's never the same again after that happens. And that's kind of in jest. But the truth is, this is actually real serious, where you have to learn how to structure deals, folks. If you don't, you're putting your money and other people's money at incredibly high risk. And then other investors, reality is they're just lost. They're bouncing around from one strategy to the next. One day they're flipping, the next day they're doing notes. They're trying all these different things with little to no success. And again, the reason being is because they don't know the blueprint. So another thing is, are you jeopardizing important relationships? Obviously, if you raise capital from people you know and people you love and lose it, those relationships will never be the same again. So that's the reality for most investors. Now, let me share a little bit about who I am with you and why you should listen to me, where I've been, why you should listen to me. So I have a finance degree. I actually went to college down in Florida out of high school, got a finance degree, then immediately got involved in real estate at the age of 21, like Dustin had shared with you. Had basically 15-year full-time career in real estate. I've done a number of things over the last few years, but still heavily involved in real estate, heavily involved in investing, both the residential and commercial side of the business. I've done hundreds and hundreds and hundreds of deals and tons of experience, really with everything from single families, commercial properties, notes, wholesaling, flipping, buy and holds, you name it. Basically, I've had experience with it and done it. So a ton of experience in the real estate and investing space. I like to call myself a growth junkie. So it's important that you know, I've invested literally countless hours. I don't even know how many hours, tens of thousands, actually hundreds of thousands of dollars at this point in continuing my growth, continuing my education, seminars, books, coaching, mentoring, you name it. I am a growth junkie. It's like, I know that there's always the next level that I can get to. So I strive for that. That's why I also love what I do as a trainer, and be able to share that with other people and help everybody else that I come in contact with get to that next level in their life. And I'm also personally trained, mentored, and handpicked by George Antone. So as Dustin mentioned, George Antone is the owner and founder of our company Finance. He's really the content creator of what I'm teaching you tonight. So what I'm teaching you is based on George's book, The Wealthy Code. And so he personally handpicked me to be the one that's sharing this information with the world for him. So in case you don't know who George is, I want to share a little bit about who he is with you, because it's important that you know who created this training and who created this content, and why you should listen to him as well. So George has a technology background, and why that's significant is because he worked for huge companies. He lives in San Jose. He worked for Microsoft. He was a developer for Microsoft. Then he was a developer for Intuit. If any of you know Intuit, they developed Quicken and QuickBooks, Quicken Financial Planner. George was actually the lead developer on that project. So has a technology background, but also involved in developing the most sought after finance software in the world. And he left the technology space in 2001 and got involved in real estate, started buying apartment buildings. He's owned well over 1,000 units in apartments. He's also started a hedge fund for private lending. He's also created the largest network of private lenders in the entire world. And he's raised millions and millions and millions of dollars for deals, all different types of deals, from literally infomercials and businesses, obviously private lending and real estate, but a ton of experience raising capital. And he's considered a thought leader in the investing and finance space. So that's all great, right? You know, who I am and where I've been and who George is and where he's been is all great. But it still begs the question, why should you listen to us? Why should you listen to George? Why should you listen to me? So I can tell you George has been the best-selling author of these 3 books, The Wealthy Code, The Banker's Code, and Debt Millionaire. But you know what? Who really cares about that? I could tell you he's been a radio host on the Wall Street Radio Network. But again, who cares? I could tell you he's founded the largest network of private lenders. But once again, who really cares? So here is why you should care, and here's why you should listen. Because this information, folks, can be the difference between success and failure for you. I know it was for me, and I'll share a little bit about my background with you. I'll keep it brief here since, you know, we're on a limited time. But essentially, like I said, I got involved in real estate in 2001, right before the market soared. And I'm from New York, and that's where I have done a bulk of my real estate business was in New York. And in 2001 is when I got involved in real estate, right before the market took off. And for the first 7 years of my career, I was doing incredibly well. And I was one of the people that lost everything when the market tanked in 2008. So I can tell you from personal experience that the reason that I lost everything, and the reason that just about every investor that I've met, that I've talked to and connected with, that lost and got hurt and lost their shirts in 2008, was because, quite simply, they did not have, just like I did not have, this information that I'll be sharing with you tonight. So that's why you should listen, because we are at a time right now where we're at another peak in the market. The market's about to correct and potentially crash again. So there's literally not a more important time for you to get this knowledge, to get this training, and to get this information than right now. So I hope you pay close attention, take really great notes tonight. So are you ready? I hope you are. So here we go. So we're going to start out, this is our agenda for tonight. This is the agenda for the training. We're going to start out with the deal. So let's talk about the deal. It's time to discover the blueprint. So again, we want to learn to generate passive income from any income producing asset. So here's the deal. We're going to do a sample deal here. Normally we do this live and in person, but since you're at home, we're going to take you through this process. We're going to work on structuring a deal together. So here's what it is. You're looking for a long-term 10-year buy and hold for income. You find a great income producing asset. It's $100,000, and you want to structure the safest deal possible for passive income. Once again, the safest deal possible. So again, this is for any income producing asset. It does not need to be real estate. The reason I put a home and a house on this deal is just so you can feel nice and cozy, since you're most likely real estate investors. So let's take a look at how to structure this deal. Again, 10-year buy and hold for income, $100,000. So we want to pick, you see on top, it says pick the best 80% LTV loan. So we're going to do an 80% loan and a 20% down payment. So there are 5 options on the screen. And what I want you to do is go through these 5 options, and at home, just write down what do you feel is the best option for the loan. So we have loan A, 4.2% interest rate, 15-year fixed amortized. Loan B, 4.7%, 20-year fixed amortized. Loan C, 6% interest only, fixed for 10 years. Loan D, 4.9%, 30-year fixed amortized. Loan E, 4.6%, 25-year adjustable. So which do you think is correct? Just write down your answer, and we'll review in just a little bit. All right, so that's the loan. Now let's look at the down payment. So we have 6 down payment options to choose from, and I want you to choose the best option for the down payment, again, for 20% down payment. Option 1, use most of my cash for the down payment. Option 2, 8%, borrow money from Aunt Jamie, interest only for 10 years. Option 3, 0%, use your credit card, special 1-year promotion. Option 4, 6.5%, borrow from your friend John at a 5-year fixed amortized loan. Option 5, 6.1%, tap into your HELOC, which is a home equity line of credit. Option 6, 50%. Give your friend Sam 50% ownership of the deal for putting the down payment. So hopefully you have your answer at this point and you know which you would choose. So let's just take a look here. Actually, let me go back a slide. So I'm not sure what you chose since you're at home and I can't interact with you right now. But what I can tell you is this. When we do this live and we have an audience of people, every single place that I've done this, and I've done this literally dozens of times, probably 50 plus times now all over the country for all different levels of experience in the audience, we get every single option possible. So there's 30 different combinations possible from 5 loan options and 6 down payment options. And without fail, we get every single combination possible with a very simple deal to put an 80% loan and a 20% down payment for a very simple buy and hold deal. And so why this is significant, and I want to share with you, is because there is one correct answer to make this deal as safe as possible. And what I want you to understand is that most investors do not know what the correct answer is. They don't know what the best way to structure their loan is and what the best way to structure their down payment is. And these are very simple strategies that you'll be learning tonight. By the end of this webinar, by the end of this training, every single one of you will know within just a couple of seconds of looking at this deal exactly what the right answer is. We'll all be on the same page and you'll know exactly what to do just from a couple of very simple but very powerful strategies. So I like to share this example with you so you can see what we're up to and what we're working on. Okay, so let's move on. So that's the sample deal. So now let's talk about the problem. Pretty simply, the problem is people are losing their shirts because of incorrectly structured deals. Again, looking back to 2008 and what happened then, and looking at where we are now in this economic time and where we are in the financial cycle, the problem is most people's portfolios and most people's deals are set up to have them get crushed again 10 years later after so many people got crushed 10 years ago in 2008. So this is a problem. They don't know how to set things up the right way. They don't know how to put their deals together. So we're going to be going through this and giving some really powerful information here tonight. All right, great. So let's talk about the foundation of the blueprint. So the foundation of the blueprint, you see on the screen, the top tier investor triangle. So there are essentially three sides to any deal. On the left side, there's raising capital, you can see. On the right side, there's investing in the right assets. And on the bottom, there is structuring capital correctly. So these are the three sides to any deal. Now on the raising capital side, for example, you go out and you raise, I don't know, $100,000 from a friend or a family member to put into a single family home. So that's the asset side. Now, structuring the capital side is, how do you structure that capital? Should it be equity? Should it be debt? If it is debt, how should you set it up? How long should the loan be for? What's the better option there? So what we focus on is the capital structuring side on the bottom. The reason that is on the bottom of this triangle is because it is hands down the most important part to putting your deals together and creating success as an investor. Most people focus on the asset side. Most of the trainings out there focus on the asset side. Very few people, a lot less than know about the asset, know about how to raise capital and how to be effective there. Almost nobody understands how to structure their capital correctly. So that's where we focus. It's actually the most important part. It's where the most money is made, and it's where people lose their shirts, is with how they structure the capital. So that's where we'll be focused tonight. Again, just write this down at home. So just to simplify it a little, you have capital, you have assets, and you have capital structures is what we call it, capital structures. This is where we're going to be focusing our attention. So let's just go through some terms so you can understand. On the capital side, you're probably familiar with these, but on the capital side, you have how to raise money, mortgages, seller financing, creative finance, syndication. So those are just some terms on the capital side you're probably familiar with or may have heard of. Let's look at some terms on the asset side. On the right side, you have rental properties, buying notes, mobile homes, apartment buildings, trust deed investing, and tax liens. So those are some terms on the asset side. Again, we'll be focusing our time and energy on the capital structure side, the most important piece that very few people know about. So let's start with a couple of definitions. What is the definition of debt versus equity financing? Again, this is on the capital structure side. So very simply, debt financing is a traditional loan. So any mortgage or any loan that you get to purchase an asset. So let's just say I lent you $100,000 to go buy an asset, and I charged you 10% interest. So you can borrow the money from me, you'll be making payments to me, and eventually you have to repay me the entire $100,000 plus interest along the way, right? So that's debt financing. Equity financing is if I were to invest my money with you, let's say I invested the $100,000 with you, and instead of you being obligated to make payments to me, I'll share in the upside, but I'll also share in the downside of the deal, right? So I'll be an equity partner. I'll have equity ownership in that deal and share in the upside and the downside. So important that you understand these basic definitions, debt financing versus equity financing. So on the screen, we have a skeleton, right? So what is a skeleton? We all know what a skeleton is. It is the body part that forms the supporting structure of an organism, right? So our human bodies have a skeleton. That's why we're the shape we are. Right? So similarly, every single deal you ever do for passive income has a skeleton that forms the supporting structure. And here's what it's made of. So basic deal structure. Your deal skeleton is made up of leverage, spread, and this little red squiggly line, which is income volatility, which we won't be diving into details on that tonight, but we are going to break down leverage and spread and start diving into those components. So this is the basic deal structure. This is your deal skeleton. Leverage, spread, income volatility. And we're going to be breaking this down and expanding on these parts. But basically, once you master this, once you understand this basic deal structure and master it, you literally can apply this blueprint to any income producing asset and do some really amazing things with anything out there that produces income. You'd be blown away by what you can do with this information. So I want to give you a little bit of an analogy so you can understand how these components fit in and how it all works to have you be able to structure your deals correctly for passive income. So I want you to imagine driving a car, right? So if you're driving a car and you press down on the gas pedal, what happens? You go faster, right? So if you press on the gas pedal of your car, you're going to go faster, you're going to accelerate. If you let off the gas pedal, you'll slow down. And then you have in front of you your dashboard in your car, which you can look at your dashboard and see how fast you're going. So that's your speedometer, right? In your car, you have your dashboard. Similarly, with a passive income deal, I want you to think of the bottom deal dials, leverage and spread, like the gas pedal in your car. So the deal dials, leverage and spread, are like the gas pedal. And the results, your dashboard, just like your speedometer up top, are return and risk. So with any deal you have for passive income, you can adjust the leverage and spread. Again, those are the pieces of the basic deal structure. And you can adjust those. And by adjusting leverage and spread in your deals, you can literally create the return and the risk that you want for your deals. And if you can't, you just know not to do the deal. So that is basically the deal structure. That's how you create whatever you want as the results of your deal in return and risk. Okay, so hopefully that analogy was helpful for you. All right, so looking at this in more of a full basic deal structure. So we have, again, leverage, spread, income volatility, and this is the basic deal structure that we'll be working with. All right, so that's the foundation of the blueprint. Let's talk about the spread. Let's talk about structuring the spread. So I'm going to give you a little example. So let's say you walk into Target. You know, the sliding door is open, you walk into Target, and right in front of you is this whole table of black boxes. And these black boxes cost $12,000 to purchase. And if you buy this black box for $12,000, it'll spit out $100 in cash every single month. But you don't have the $12,000 to buy the black box. So you go to your Uncle Dustin. Your Uncle Dustin has $12,000 sitting in an account. And you say, hey, Uncle Dustin, I have a deal for you. I want to buy this black box for $12,000. So I want to borrow $12,000 from you. And in return, I will pledge the black box as collateral against your loan, and I'll pay you $50 a month. So your Uncle Dustin, being a savvy investor, says, sounds like a great deal. So you borrow the money from your uncle, you go back to Target, you buy the black box, you take it home, you put it on your shelf, and every month it is now spitting out $100, right? So again, we're talking about the spread here. So you have this black box paying you $100. You turn around, you pay your uncle $50. So what is your spread in this example? Hopefully you said $50. So you make a $50 spread in this example, right? Okay, so let's look at this in a bit of a different way. You have the income producing asset on the left. You have leverage on the right. So those are your definitions, right? You have an asset. And in this case, we want to make sure it's an income producing asset. And then on the right, you have leverage, borrowed money, okay? So basically, you need two things for passive income, folks. And a spread is the same thing as arbitrage. If you've heard the word arbitrage out there, it's the same thing as a spread. So you need an income producing asset and you need leverage, once again, okay? Now, we call this a wealth pair. When you have an income producing asset and leverage and you have a positive spread, we call this a wealth pair. So let's look at this in a bit of a different format. So again, you have an asset on the left. In this example, the asset is paying you 10%, okay? 10%. Then you have leverage on the right that you're paying 6%. So what's your spread in this example? Well, again, hopefully you said 4%. So you're making a 4% spread here. All right, I'm going to introduce a couple of terms that you may or may not be familiar with that are incredibly important. So pay close attention. So on the left side in this example, you now have an asset that's paying you 10%. So this is not in the form of dollars, like $100 from the last example. Now it's saying 10%. So what is the term that lets you know how much an asset pays you in the form of a percentage like this that says 10%? Well, what this is called on the left side when the asset pays you is called a capitalization rate, also known as a cap rate. Don't worry about the details right now. Just know that a cap rate is a measure of the net income coming from an asset, okay? So cap rate is a measure of the net income. Just jot that down. Then on the right side, you have leverage, right? So in this example, the leverage, you're paying 6% towards the leverage. So what do you think that term is to measure your payments going towards the leverage? Most people think that's an interest rate, but it's actually not an interest rate. Interest rate is just a measure of the interest you're paying towards a loan, right? So in this case, this is a measure of principal and interest going towards paying leverage, and it's called a loan constant. Loan constant. Make sure you write that down. One of the most important terms and one of the most important metrics that you can know and you can understand when it comes to putting deals together for passive income, okay? A loan constant. And what a loan constant is it's a measure of the payments, both principal and interest, going towards paying your leverage, okay? So here we're measuring the difference between the cap rate, the net income, and the loan constant, the net payments going towards the leverage. And obviously, we want to make sure when we're doing deals for passive income that we have the cap rate is higher than the loan constant, right? Once the cap rate is higher than the loan constant, that's positive leverage and that's positive cash flow, okay? So very important that you understand these metrics. All right, so let's take another look. Once again, you have an asset that's paying you in a cap rate. You have a loan leverage that you're paying a loan constant, and what you have in the middle is your spread. Okay, so that is basically the spread. And you want to make sure you have the widest spread possible. When you have the widest spread possible, you have the safest deal possible because you have the most income left over after paying operating expenses and after paying your debt service, and therefore you have a much safer deal. If you're barely breaking even or you're barely in the positive cash flow range with an income producing asset, you're in an incredibly risky position. All right, so the wider your spread, the safer the deal. Okay, make sure you write that down at home. The wider the spread, the safer the deal. And again, our objective here is to learn how to structure deals for income to be as safe as possible. Because as savvy investors, we know, and hopefully you know, and we'll realize that the safer the deals are you put together, the more deals you can do. The more deals you can do. When you know how to structure deals for safety, you can raise so much more capital, and you can make sure you don't lose people's money and don't lose your own money, which is the recipe for long-term success, okay? So here we are, key lesson for module 1. So this was module 1 on spreads, how to structure the spread. Key lesson, to generate a spread, you need an income-producing asset and leverage. The cap rate on the asset side must be larger than the loan constant on the leverage side. The difference between the cap rate and loan constant is the passive income in your pocket, okay? So I'm gonna pause now and I wanna see if there are any questions that I can answer, because I know I just went through a whole lot of information and covered a lot. So my assumption is that there probably are some questions. So let me open this up and just see if there are any questions. I will turn my webcam on as promised. And Dustin, any questions for me?
Yeah, Angelique asked if you can repeat about the loan constant and why it's so important.
Absolutely, I'm happy to. So actually, let me give you a little example for everybody who's on and listening. So loan constant, I want you to imagine you have a deal that you want to put together and you need a $100,000 loan in order to purchase an asset. Okay, so $100,000 loan. And you find 3 different borrowers, borrower A, borrower B, lenders, lender A, lender B, lender C. So you have 3 different lenders that are willing to lend you the money, the $100,000, and they're all going to charge you 10% interest, okay? So this is an example to demonstrate loan constant. I hope this is helpful. So you have 3 lenders willing to lend you money, 10% interest rate. So far, all of those loans are the same. Now, you have lender A, and lender A says, what I want you to do is pay me $10,000 a year. All you have to pay me is the interest each year. So lender A says, pay me $10,000, and we're good. Lender B says, I want you to pay principal and interest. I want to have this loan paid off as quickly as possible. So I want you to pay me $24,000 per year in payments. Okay, so with lender B, you have to make $24,000 a year in payments. Then lender C says, you know what? Just pay me $1,000 a year in payments. As long as you pay me $1,000, we're good. Now, you have $10,000 in interest each year, but the other $9,000 are added to the top of the loan. So the loan amount will be growing each year, right? So again, this is for an example so you can see what loan constant is and the power of it. So which loan would you choose? Loan A, you have 10,000 a year in payments. Loan B, you have 24,000 a year in payments. Loan C, you have 1,000 a year in payments. So let's look at these different scenarios and figure out which one we would choose. So with loan A, you're making $10,000 a year in payments. Now, if you have a good year with loan A, you have flexibility. You can pay more. So let's assume there's no prepayment penalty, by the way. So if you choose loan A, it's interest only. You can pay it off. You can make $10, $11, $12, $15,000 a year, 20. You can pay $24,000 a year in payments if you want. You have the flexibility to make whatever payments you want, but you're obligated to make at least $10,000 a year in payments. Now with loan B, if you're obligated to make $24,000 a year in payments, and you have a bad year or maybe two bad years in a row, what happens if you can't make those payments? What's going to happen to the asset? In the example of real estate, it's going to get foreclosed on. You'll lose the asset, right? So incredibly risky to have a high obligation to make payments to your lender, right? Now in example C, with $1,000 a year in payments as the minimum obligation, again, if you have a good year, decent year, you can just pay the interest. You can pay it off, pay it down, make $24,000 a year in payments, pay it off in a year if you want. But the key thing that you need to realize is that if you have those bad year or two in a row, you are keeping the asset and the invested money that was the down payment, and you may have raised money from friends and family for that down payment, you're keeping it much more protected, right? Because if you have a bad year or two, there's a really good chance that you could still come up with enough money to make $1,000 a year in payments to your lender and not lose the asset, right? So hopefully that example is helpful. And that's an example of loan constant. So basically the formula for loan constant, just so you understand what the formula is, very simple, is your annual loan payments divided by the loan amount. So in these three examples, your annual loan payments are $10,000, $24,000, and $1,000. And the loan amount is $100,000. So in these examples, your loan constants, very simply, are 10%, 24%, and 1%. So that's the power of loan constant. The lower your loan constant, the safer the entire deal structure is. And the thing is, so many lenders out there, so many mortgage brokers will suggest that you get loans that actually have a much higher loan constant without even realizing it. So they don't even understand these concepts. Banks, I can promise you, understand these concepts. And loan constant is actually the way that banks shift risk from themselves to the borrower, to you. They don't tell you about loan constant, but they always tell you about the interest rate, right? And they entice you with the lower the interest rate for the shorter term loan. But what you don't realize as an investor, as somebody that's investing in properties for cash flow, is that typically you're going to have a much higher loan constant. And again, if you look in 2007, 2008, the loan constants were incredibly high with the types of loans that people were getting. And that's why so many people got hurt. So hopefully that example was powerful for you to have a better understanding of what loan constant is and how it works and how it applies to structuring your deals for income. So any other questions I can answer now?
Yeah, we got one more about the loan constants from Jason. He says, what's the relationship between loan constant and interest rate?
Yeah, so the interest rate factors into how you calculate your loan constant. So once again, Jason, the loan constant, the formula to calculate loan constant is really simply your annual loan payments. So if you took your monthly loan payments times 12, divide by the loan amount, right? So what your monthly and annual payments are, your interest rate does impact what those payments are, right? So, but also what impacts what your payments are, quite simply, it's three factors. So it's your interest rate, it's whether or not the loan is amortized or if it's interest only, and it's the term of the loan for amortized loans. So 15-year, 30-year, right? So obviously the longer the term of the loan, if you have a 15-year loan, your loan constant is going to be higher. If you have a 30-year loan, it'll be lower because you're stretching it out over a longer period of time. If you have an interest-only loan, it's actually going to be the lowest loan constant possible, okay? So that's the relationship between interest rate and loan constant, and that's how it factors in, and that's how you calculate loan constant.
That's all the questions for now.
Okay, great. I'll continue on. Turning my webcam off so we can go back to the slideshow. Okay, so once again, key lesson for module 1, you want to make sure when you're investing in assets for passive income that you measure your cap rate, which is a measure of the net income, measure your loan constant, and make sure your cap rate is higher than your loan constant, and that you have a positive spread. Okay, so we're looking at spreads. All right, so back to the basic deal structure. Once again, the basic deal structure. We have leverage and spread, and what we just, and this red squiggly line, income volatility. And what we just discovered is that your spread is the difference between your cap rate and your loan constant. Once again, you want to make sure you have the widest spread possible when you're putting deals together for income. Okay, very important. All right, so back to the sample deal that we started with, and looking at those 5 options for the loan, A through E. And now let's look at these loan options with the loan constants calculated for us. So we calculated the loan constants at the bottom in red. So now, knowing what you know about structuring deals and making sure that you have the lowest loan constant to have the safest deal possible, hopefully every single one of you can now look at these 5 options for these loans and know in just 2 seconds looking at it that you'll choose loan C. And you'll choose a loan C because it is the lowest loan constant. Period. Simple. End of story. If you want to make the deal as safe as possible, you want to make sure you have the lowest loan constant because that is going to give you the widest spread possible. Okay? So now we're all on the same page and we know how to select a loan when we're putting deals together for income. And what's interesting about these options that I want to point out to you is that loan A has the lowest interest rate, 4.2%. But it also has the highest loan constant. And why is that? Because it's a 15-year. It's a shorter term, right? Loan C has the highest interest rate, yet it has the lowest loan constant in this example, again, because it's an interest-only loan. So just to point out and highlight again for you folks, most loan officers, bankers, mortgage brokers, most investors, most people, we've been conditioned. And who do you think we've been conditioned by? The banks, to go for the loan with the lowest interest rate because it's in their best interest. Typically, they're going to entice you with lower interest rates for shorter term loans that have higher loan constants. But it's important for you to know for yourself, when you're putting your deals together, you have to be responsible to know how to make them as safe as possible. And so it's not just about looking at interest rate. It's about looking at the loan constant, making sure that you calculate that for yourself. So hopefully you got that by now. Again, loan constant is one of the most important metrics to understand and to know. And literally, just by knowing this, you know more than most investors out there. 95+% of investors out there have no idea what a loan constant is. I've never heard of it. If you started talking to people about loan constant, they'll be like, what the hell are you talking about? Pardon my French. But they don't know. They don't understand it. And hopefully now you do. All right, great. So that was structuring the spread. Next up on our agenda is structuring the down payment. So let's talk about the down payment a little bit. So there are basically 3 main components to any passive income deal. You have the asset, you have the leverage that we just talked about, and then you have the down payment. For most assets, you have to put a down payment in order to be able to get leverage, borrowed money, in order to put the deal together, right? So there is a down payment component that we want to look at and talk about and figure out what is the safest way to structure the down payment. So that's the question. What is the safest way to structure the down payment? So let's look at the 3 main options you have for down payment. So basically, you have these 3. You have your money, your capital you can use. You have equity financing. We talked about what that is earlier. A partner, basically. You raise money from somebody. They come in. They're a partner. They share in the upside, but they also share in the downside of the deal. And then you have debt financing, borrowed money. Could be a loan from a friend or family. Could be a HELOC that you use for the down payment. So these are essentially the 3 main options for how to structure your down payment, okay? So I want you to think about it for a moment. Which one of these do you think is the safest way to structure the down payment? Come up with your own answer. Use your money, bring in an equity partner, or use debt financing, borrowed money. What's the safest way? Well, as it turns out, the safest way to structure the down payment is to bring in an equity partner. The next safest way is to use your money. The most risky way to structure the down payment is to borrow the money, is to use debt. And I'm going to give you a little example here to explain why, okay? So imagine you have two identical 100-unit apartment buildings side by side. Let's say you buy the one on the right and a friend of yours buys the one on the left. So you both decide to get 80% mortgages, but you, having this training, decide to use equity financing for your down payment. Your friend, on the other hand, says, no, you know what? I want this whole deal to myself. I don't want to give any piece of this deal away. I want to have the whole thing for myself. I'm going to use debt financing to finance the down payment. They take a loan out from their home equity line of credit, and they finance their down payment with debt. So we want to look at what is the consequence of this one very simple single decision. So with you on the right, because you used equity financing for the down payment, you can afford to have an 18% vacancy. So you only have to be at 82% occupancy in order to break even on this property. So with a 100-unit apartment building, 18 people can move out until you're at break even. Your friend, on the other hand, who used debt financing for the down payment, they can only afford to have a 6% vacancy. And these are loosely speaking numbers. The number on the left is actually 5.5%. So what that means is your friend on the left-hand side, they can only have 5 people move out and then one person be halfway out and halfway in, and they're at break even. So what does that mean? Well, anybody who knows anything about commercial properties and an apartment building will tell you that you have to assume a certain level of vacancy. And does anybody know what that is, I'm wondering? Well, the vacancy you have to assume, and this is what you'll learn, and this is the reality of it, is 5%. So if you have to assume 5% vacancy, and you only can be at 5.5% or 6% vacancy before you're at break even, what's the impact of that decision to structure the down payment as debt financing instead of equity financing? Well, the impact is you're probably going to have a lot of sleepless nights. You're probably going to be stressed out, constantly calling people for help, and most likely 3-4 years down the line, you'll lose this building. You'll lose the property. So this is the impact of a very simple decision of how to structure the down payment. And again, what I can tell you is that a lot of people don't know this information and are, now that we're in this economic climate we're in, again, what do you think happened in 2008? People were borrowing money against existing properties, taking out lines of credit, using that money for down payments, using credit cards for down payments. It is incredibly, incredibly risky for people to structure their down payments with debt and have 100% debt financing on an asset. And it's only a matter of time when you structure your deals that way that you'll lose and you'll get crushed, right? So again, the safest way to structure your down payment is with equity financing. So let's look at a sample deal here. Now that you understand that, you have this deal, it's paying you a 10% cap rate. Again, the cap rate is a measure of your net income. You want to compare down payment options. So which one would you pick? So you have 2 options for a down payment. You have Sam, who's willing to come in, put up the whole down payment to be a 50% partner in the deal. And then you have John, who's willing to lend you the money for the down payment at an 8% loan constant. So hopefully you all said at this point, let me go back there. Hopefully you all said that Sam is the way to go. Sam, being an equity partner, is a much safer way to structure the down payment than to use John, who's more debt. So you have 100% debt on the asset. Incredibly risky. All right, so the key lesson here for module number 2, the safer way to structure a down payment is using equity financing. Okay, so let me pause again and see if there are any other questions that are coming in and make sure that I address your questions. Incredibly important for me to make sure you're all following along. So I cannot stress enough, if you have questions, please ask them. You know, we do what we do and we do our trainings to really make sure that we help people. I can't help you and I can't help answer your questions if you don't ask them. So I really urge you to ask any questions that you have. I'm happy to answer them. So I'll turn my webcam back on. And let's take any more questions that have come in.
All right, this question's from Braxton. He said, so where do you find private lenders with low repayment rates? Friends and relatives may not have as much cash.
Yeah, so it's a really great question. It's not something we're covering in this training, is where to source capital from. So again, if you remember the triangle, you have the top tier investor triangle. So you have the capital side. And the question that you're asking is, on the capital side, where to get the capital from. What we're talking about here is how to structure the capital. So, I mean, that's a really long answer to that question of where to find capital and where to find the best rates. And it's just not something that we're covering in this training. So sorry about that.
All right, this next question is from Sophie. Does a balloon affect your decision making? And she was asking if C had a balloon.
Yeah, it's a really great question, Sophie. So yes, absolutely. A balloon will affect your decision of what loan to choose. And really, you know, we're in this short 90-minute training tonight. We obviously have a full workshop that will go over a whole lot more detail and give you the full picture so you can really master this skill of structuring deals. But the short answer for you, Sophie, is this. When you're looking at what loan to choose, you want to look at what your exit strategy is for whatever that asset is. So you want to be clear when you're going into an investment, what is your exit strategy? How long, we're talking about in real estate here, for cash flow, we're talking about buy and holds, obviously, right? So how long do you want to hold on to that asset for? Is it 5 years? Is it 10 years? Is it 20 years? So based on your exit strategy going in will determine which loan you choose going in as well, right? So that's the answer to that question. That's the short answer to that question, but hopefully that helps. Any other questions?
Yes, we got a few.
Great.
This question's similar to the one before, I think, and it's from Shonda. She said, what's a good place to find equity financing? And then somebody else said they tuned in a few minutes late and wondered what the definition of equity financing was.
Got it. Perfect. So yeah, as far as the question, where to find equity financing, it's a separate training as far as, you know, how to raise capital. So it's a whole separate skill set. Again, that's on that left side of the triangle, raising capital, or the capital side, where to get it, whether it's loans or whether it's raising capital. And that's a whole separate skill set to learn and a whole separate training. So I won't dive into the details here because we're keeping it focused on the capital structure side of things. And what was the second question, Dustin?
Somebody had tuned in a few minutes late and didn't hear your definition of equity financing versus debt financing.
Okay. Perfect. Yeah. So equity financing, very simply, is financing, again, raising capital from an equity partner. So let's say I raise capital from you, you invest in a deal with me, and I'm not obligated to make payments to you like debt financing, like a mortgage or a loan. You're going to share in the upside of the deal. So I say, you know, invest this capital into this deal and you'll share in the profits. I'll give you 30 or 40 or 50% of the deal. So that's equity financing versus debt financing, which is a traditional mortgage or a loan that you get in order to fund a deal.
Okay, this question is from Jason. He said, so in the 100-unit apartment example, would you still have the lender finance the other 80% of the building if the equity partner came up with a down payment? Absolutely. Yeah. So what you'll realize, this is a great question, actually, so thank you for asking it. What you'll realize is that, you know, so what we're getting to here, folks, is that there is a level of safety, and that is typically in an inverse relationship with the level of return. So your risk, actually, let me do it on the other side if you're seeing this at home, because we have return on this side. So you have return, and then you have risk. They typically move in opposite directions of each other. So there's the right balance to have between risk and return in your deals, and you want to understand and learn how to measure both and how to have the right balance between the two. The amount of leverage that you use in your deals and how big the spread is essentially are going, those are your deal dials. Remember that? So we have the basic deal structure. You have your deal dials, which are leverage and spread. By adjusting the amount of leverage you use in your deal, so in that apartment building example, we used 80% leverage, and how big your spread is, by adjusting those dials, that's how you're going to adjust your return and your risk metrics. So we're going to be getting to, we won't be covering in detail tonight, but at the full workshop, you're going to learn and literally master the skill of how to adjust leverage and spread, how to measure risk and return, and how to know and get the right balance between the two. So in that apartment building example, absolutely, you'd want to still finance with debt financing that 80% for that deal. So this way you're leveraging. That's why it's called leverage, is by leveraging, you're increasing your return, your cash on cash return, your internal rate of return. So your return is going to go up when you have
more leverage, but your risk is also going to go up. So the more leverage you use, it's raising both return and risk, but you want to have the right level of both. And again, at the full workshop, we'll teach you in detail. Not only will we teach you, but you'll practice and you'll learn by doing how to actually measure both and how to find the right balance between the two. So that's a really great question.
Here's another really good question from Leanne. Why is equity partner better than my money for down payment if I have money for a down payment to put into the deal?
Yeah, great question. So that is a really great question. So let me ask you this question to answer your question with a question. If you use your money, let's just say, for instance, you had $20,000 and that's pretty much all the cash you have, right? So you take your $20,000 and you put it into a deal as a down payment. Well, there's a few different consequences to making that decision and using your capital for the down payment as opposed to raising $20,000 from an equity partner and using their capital as a down payment. So again, an equity partner shares in the upside, but they also share in the downside of the deal. So if the deal goes south, it's their money on the line that might get lost as opposed to yours. And they're obviously understanding that coming into the deal, that there is a risk associated with investing their money. And obviously you're going to structure the deal to be as safe as possible for them and for you, but actually more importantly for them as the investor in the deal. But there's another thing. If you invest your money into the deal, it's locked up. It's in the deal. And you don't have access to that capital. You don't have access to that cash anymore. What you'll learn, again, there's only so much I can explain this now with the level of knowledge that I'm able to share with you here tonight. But again, when you come to the workshop, you'll have a full, complete understanding of how this works and all the different nuances to why you want to do it this way. But the short answer here for tonight is this. If you have your money locked up into a deal, it's not available as cash. It's not liquid. And when your cash is liquid, let's say you had that $20,000 and you had it sitting in a bank account, a checking account, or a savings account in what we call a reserve account, you can literally do multiple deals. You can put multiple deals together because you have that $20,000, your cash, sitting in an account. You can raise capital from more investors. You can potentially get multiple loans because you have that cash sitting in your account. So not only is it safer for the deal structure for you because it's somebody else's capital invested in the deal, and remember this, the down payment is the highest risk money in any deal. The down payment is the highest risk money in any deal. The lender's money is in a much safer position in the deal. But you also have your capital locked up. And when it's locked up, now you have to go save $20,000 more if you want to do another deal. Whereas if you kept it in an account, a reserve account, you can actually do multiple deals with that money. When you come to the workshop, we're going to explain a lot more about that, and you'll fully understand how that's possible and how to actually make that work. So I hope that clears things up for you.
Yep. 3 more really quick questions. Yeah. One I think you just answered for Doug. He says, it's safe to use my money from a solo 401k to use for down payment.
Depends on the structure of your 401k. So when it's all really numbers based, Doug. So you have to know your 401k. I don't know if you have any penalty for drawing the money out and using that money. If you do, you have to factor that into the cost of the money and see if that is the best option for you to use. If there is a cost to the money, it's essentially like borrowing money. So you want to be careful with that. Again, just depends on how your 401k is structured and what penalties or fees that you would incur for using that money. So that's the best answer I have for you tonight with the knowledge that I've shared with you so far. Come to the workshop. You'll have a much more clear understanding of how that calculates and factors in and be able to make a much better decision about that after the full training.
All right, 2 more really quick questions. This one's from Braxton. Do you typically involve an attorney with equity financing deals?
Absolutely. Involve an attorney with everything. So you want to make sure, you have the right contracts in place, you have the right agreements in place, that, that everything is, everything's on the up and up as far as the legal agreements. So yeah, without a doubt, you want to have attorneys involved.
Okay. The last question for now, could you share how you came up with the 18% vacancy rate when you were talking about those 2 commercial deals?
Yeah, well, it's a formula. So, basically it's a break-even formula. So I won't go into the details of actually the formula and how to calculate it tonight. but just know this, if you want to just jot it down, it's just a very simple break-even formula. At the workshop, you'll be calculating the break-even formula yourself. You'll be able to see what the break-even ratio is. We'll teach you how to calculate that. But basically, it's a very simple formula to calculate the break-even rate, and that's how you do it. Is based on the mix of equity and debt, based on the cash flow, based on the income. You can calculate what the break-even rate is on assets. And we're going to teach you in detail. You're going to, again, everything I'm talking about, we're not just going to teach you at the workshop, but you're going to practice doing it yourself. We have very interactive, and so you'll get experience doing it yourself so you can fully understand how to do it.
Okay, that's all the questions for now.
Okay, awesome. Great questions, everybody. It's so awesome. So keep those questions coming. I'm going to go back into the training, and let's continue on here. So webcam off, and here we go. Okay, so again, back to our basic deal structure now after the down payment. So again, we have our basic deal structure, leverage, spread, income volatility. What we just discovered, once again, what I shared is that the higher your leverage, this green arrow, the higher your leverage, the higher your risk, but also the higher your return. So by having the down payment be equity, it's lowering the amount of leverage that you're using in the deal, therefore making the deal safer. So when your down payment is equity financing, or your cash is the second best deal. If you have a good amount of your own cash, it's fine to use your own cash in a deal for the down payment. Again, that just looks at your whole portfolio and what makes sense to do and what not to do. But important for you to know, the down payment piece being equity is going to lower the amount of leverage you're using in a deal, therefore make the whole deal safer. And once again, your spread is the difference between your cap rate and your loan constant. Okay, so those are basically the two lessons we're covering here tonight. So we're going to look at the 20% down payment once again from the deal example that we did. So we have 6 options for the down payment. Now, hopefully, every single one of you, once again, can look at this within 2 seconds, know that option 6 is your best option for the down payment to make the deal as safe as possible. It's the only equity partner option on here. So once again, now you can look at this and know, okay, I have these 6 options for my down payment, going with the equity partner if I want to make this deal as safe as possible. Okay, so hopefully now you see, again, people are out there all over the place, investors everywhere making the wrong decisions of how to structure their loan and how to structure their down payment. These are 2 incredibly simple to understand, yet incredibly powerful strategies for how to structure your deals to be as safe as possible so that you can have longevity and have long-term success instead of being stressed and losing money and losing properties and losing assets, right? So this information really by itself, these 2, in less than an hour, 2 very simple strategies set you apart from almost every investor out there. You go talk to people about this, they'll have no idea what you're talking about. All right, so let's just talk about and review some of the key lessons here. So 3 skills of a top-tier investor. Once again, raising capital, investing in the right assets, and structuring capital correctly. So the basic model for passive income: income producing asset, down payment, and financial leverage. You see, you want to have a checklist for each. There's full checklist for each of them. We'll actually give you the full checklist at the full 3-day workshop, passive income course. So every deal you do, you can run each component of the deal through the full checklist, have a complete understanding of how that works, and make sure you're doing things the right way. Once again, you have the cap rate on the asset side. That's a measure of your net income. You have a loan constant on the leverage side. The difference between the 2 is your spread. Obviously, you want to make sure you have the cap rate higher than the loan constant. And then as the down payment piece, you want to make sure that that is structured as equity, okay? So wealth pairs. Your goal is to have a portfolio of wealth pairs generating passive income, structured to be low risk and as hassle-free as possible, okay? Low risk and as hassle-free as possible. I cannot stress the low risk part of this enough. Low risk is the most important piece to this puzzle. If any of you know Warren Buffett, one of the most successful investors of all time, maybe you saw my video I recorded for you about this, Warren Buffett's rules of investing. Real quick, very simple. Rule number 1, never lose money. Rule number 2, never forget rule number 1. He is one of the most successful investors of all time for a reason. Those are his rules of investing for a reason. That is why you want to make sure your deals are structured to be as low risk as possible. That's what we're going to teach you. It's what we're starting to teach you, and we'll continue teaching you the skill of structuring your deals correctly to be low risk so that you can master it and have long-term tremendous success as an investor. Okay, so those are your key lessons here. So let's talk about the importance of receiving the right training. So here we have our friend Homer Simpson. Bart drawing on the back of his head, insert brain here. Am I dumb? So this is a joke, obviously, but the reality is traveling all over the country, meeting investors all over the place, I constantly have people asking me this question. Reason being is because they've taken tons of other trainings and they're still not having success. So they feel like it's their fault that they've learned this knowledge, they've learned some information, and they're still not able to create success as investors. So what I like to ask them is maybe a better question to ask yourself than am I dumb is, are you getting the wrong training? Are you getting the wrong training, right? So there's an article done in Time Magazine that shows why long lectures are ineffective. Why long lectures are ineffective. So we have on the screen what's called the cone of learning. If any of you have read Robert Kiyosaki's information, you probably have heard of this. So the cone of learning shows the difference between passive learning and active learning. So what it says on the left there, people generally remember 10% of what they read, 20% of what they hear, 30% of what they see, 50% of what they see and hear, and that's all passive learning. And then they remember 70% of what they say and write, and 90% of what they do. Okay, 90% of what they do. That's the difference between passive learning and active learning. And we're here tonight on a webinar, so you didn't get to get a real full experience of what kind of training that we provide. But if you were experiencing this in a live setting at one of the REIA meetings, which I encourage you to come, even though you've seen the webinar, come to the REIA meetings that are coming up, and Dustin will share those dates with you here in just a moment. But we do active learning, right? We do role playing. We'll have you actually participating in your learning so you can retain and remember and actually understand more of what we're teaching. All right, we do experiential training. You can see this picture on the screen, those cards, red cards, green cards, blue cards. So we have everybody in teams. You see the team name, Victory. They have a chant called Puya. So we have everybody working together in teams. They're actually in the process of structuring some incredibly complex deals, working together, learning by doing, figuring things out, learning by making mistakes in a training environment instead of making mistakes out in the real world. So this is our training, right? We do experiential training, incredibly interactive, the way that we do it. We do role playing. You can see we have some people at the front of the room going through examples. These are incredibly powerful strategies to learn. We do fun training. We love to have a good time. We love to laugh. We love to have fun. In fact, we have you in teams and you're actually competing with the other teams the entire event. So when you come to the 3-day passive income course, this is the structure of it. You'll be competing for prizes, for raffles, for all different types of stuff. We love to have a good time. You will be entertained and you will learn more in 3 days than you can possibly imagine. We do group exercises. So the front of the room here, you can see that they're writing something on the flip chart. At the passive income course specifically, you're learning how to structure deals for passive income like the very best on the planet. And at the end of day 2, actually maybe on day 2, we have you come to the front. You're working in groups. We give you deals to work on. You have to figure out the best deal structure for the deals we give you. All different assets, real estate, businesses, different types of things we want to have you work on structuring deals for. Then you pick one spokesperson from your group who will come to the front of the room and they'll have to present the deal and they'll have to defend the way that you structured the deal. So we're going to throw everything at you, all different questions, and they'll have to actually defend why you did this, why you did that. The benefit of that is in the real world, folks, when you're out there putting deals together and presenting deals to potential investors, presenting deals to potential lenders, they're going to ask you these questions. They're going to want to know, why did you do this? Why did you do that? We're going to train you by practicing there at the event how to answer those questions. Again, we want to make sure you're the most sophisticated investor possible, and we want to really set you up to master this skill of structuring deals, presenting deals, raising capital, finding the right assets, putting the whole thing together. That's what you're going to get. So we do these group exercises that are incredibly powerful. And the bottom line is we do active learning. So we're the leaders in experiential training for financial education, period. So the question is, do you want to learn the fun way or do you want to learn the hard way? The choice is really yours. So we have the upcoming workshop, the passive income course. I want to share with you some testimonials, what other students are saying about this. We have countless testimonials. I'll just share a few of them with you here. This one is incredibly powerful, and Dustin knows Catherine Swanberg really well. You can see on the bottom right who this is from. She runs probably the biggest club in the country, which is in the Seattle area, called REIPS. And she's been running that club for around 10 years, brings the biggest speakers in, just like Dustin does, from all over the country. And she's been through every training. She's also an incredibly experienced investor herself and on the mortgage side of the business. So she's a financial brain. And this is what she said after the training. She said, I thought I knew how to structure deals and was just blown away by concepts I've never heard before that were quite advanced, yet presented in such a simplified manner that it was easy to understand. I host a lot of events at REIPS, and I think this training is a fundamental and missing piece that is not discretionary to the investment you make in your education. In fact, I want to host this event annually and make it mandatory for all of my new members to attend. And when my kids are older, it'll be required for them too. So this is a woman that has seen all the best trainings out there. This is what she said. And she does bring us back every year now to do this training. And just can't say enough about how amazing she is and how much experience she has. And for her to say this about this training, it is not discretionary in the investment you make in your education. Like, this is necessary for any investor. If you're going to be doing any deals, you need this training, period. You have to understand how to structure your deals the right way. Next testimonial, this is from Victoria Lau, who's one of our students, absolutely crushing it, was an engineer, now full-time investor. Having come from an engineering background and having some real estate experience, this workshop has really opened my eyes to generating wealth through passive income. I'm no longer reliant on my job solely for income. I've learned the three most important concepts towards wealth building: raising money, structuring deals, and placing money in those deals. I'm more empowered than ever to take control of my financial future. And that's really what we're all about, folks. What we stand for, the mission of our company, is to set people up to really take control of their financial future. Set them up for success with math, with proven formulas, and that's the way to do it. It's not a guessing game. It is literally a math game. It is a numbers game, and we set you up with what will teach you of how to actually do that. So I'm just going to go through. We have tons of these testimonials. I won't read all of them for you. This is from Brett Calloway. Says, I'll never look at deal structuring the same. Things that I thought were making my deals safer and more profitable were in fact making my deals riskier and less profitable. This truly is a much needed foundation for any investor or business owner. I can't tell you how powerful this is. Most people think they know how to structure their deals. Most investors think that they understand this, but what Brett says here is that things he thought were making his deals safer and more profitable were actually making them riskier and less profitable. This is the case for most people out there until they get this training. All right. So again, tons of testimonials. I don't need to read all these for you. Bottom line is we've been doing this training all over the country for a few years now. George just created this training about 3 years ago. The feedback is the same everywhere we go. Anybody who gets this training is blown away by how powerful it is. Blown away by what they learned, by what they thought they knew that they actually didn't know, and how to then go out and implement it. Tons of people throughout the workshop are coming to us and saying, oh my God, I went home and looked at my deals and looked at my portfolio. I have to redo everything because I realize I'm set up for incredibly risky deals. So the question is, do you want to let more years of mistakes pass you by before you realize you need the blueprint? If you're doing deals, you need the blueprint. Imagine being able to have this much detail. So you have a deal, somebody brings you a deal, and you take quickly structure it and put the deal together with a mixture of equity and debt, and you have a 12% return, but very high risk on the right-hand side you see. Would you do this deal? Would you do this deal? Well, hopefully you said no. We don't want to do a deal that's very high risk, right? So we use what we know. We adjust our dials, leverage and spread, and now we have a 11% return with low risk. Much better deal. So now we're looking good. We adjust it again. We get to a 12.5% return, still at low risk, even better. And then we adjust it one more time. We're at 12.2% return, and now we're at very high risk again. So obviously, we're going to go with deal number 3, the one in the top right. So what I want you to get is from the training, once again, when you come and get the full training, you will leave being fully confident in how to adjust your dials, leverage, and spread to get the return and the risk that you want. Once again, we're saying here, risk is very high or low. At the workshop, we'll teach you how to actually measure risk and put numbers to risk. So you'll understand how to quantify and calculate return and risk and have numbers for both, how to adjust both by adjusting your deal dials, and set your deals up to make sure that they'll work for you, that they'll work for your investors. And once again, I cannot say this enough. Once you understand this skill, it's going to set you up to create success with any asset you choose. It's going to set you up to be able to go out and raise capital like you can't even imagine when you understand how to structure deals and minimize risk and cover the downside. Covering the downside is what it's about. Cover the downside of your deals, and you let the upside take care of itself. When you understand how to do that, you will explode your growth. Explode your growth. So next steps, opportunity for becoming a top-tier investor. So again, the workshop is hands-on interactive. You're going to learn the step-by-step blueprint for structuring capital for passive income. Literally get ready to be completely blown away by this training. And our bold promise is that by the end of the workshop, the end of 3 days, you will be structuring deals for passive income like the top 1% of investors in the entire world. Now, hopefully you think that's a bold promise too, because we know it's a very bold promise. When you come to the workshop, I will prove it to you that we're delivering on that promise. I will literally prove it to you at the workshop. Okay, and we're going to back that up with a money-back guarantee. So here's what you get with the live workshop. You're going to get 1 ticket to come to the event. Again, learn from doing through live hands-on experiential training. Learning from doing is the best way to learn. That's what you're going to do when you come to the workshop. You're going to gain confidence from new knowledge and lots of practice structuring passive income deals like the top 1%. You're going to have the ability to quickly identify the right deals by measuring and balancing risk and return. And you're going to have new insights about investing that you can't even imagine right now that will set you on a path to complete abundance and freedom in your investing career. We're also going to give you workbooks, checklists, and calculators when you come to the training. These are going to set you up for maximum results at the workshop and then after. So I can tell you this, George, being a developer, having worked on and being a lead developer on Quicken Financial Planner, has developed these incredible calculators that you're going to get, all these different Excel spreadsheets that are set up to be calculators for you to analyze and figure out how to optimally structure your deals for the rest of your life. You get those calculators when you come to the workshop, and you have them forever. We've literally had CFOs, accountants come to our training. I mean, these are numbers people that are working with calculators and spreadsheets all day and say, you literally should be, George, you should be charging thousands of dollars just for the calculator. This is a priceless tool that you've created for investors to be structuring and analyzing their deals. We're giving to you from free when you come to the training. So you also get a copy of George's best-selling book, The Wealthy Code. Again, that's what this training is based on. What the wealthy know about money that most people never will. This continues where Rich Dad, Poor Dad left off. You know, Robert Kiyosaki's book, Rich Dad, Poor Dad, hopefully you've all read that as investors, is a powerful, powerful book. Changed George's life, changed my life. But it's about mindset. It doesn't actually tell you the details and the how to be successful. It shifts your mindset, but the Wealthy Code and this training, the Passive Income course, continues where that left off, gives you the details of how to actually create success as investors. You can see at the bottom here, folks, too, that the URL where you want to go to register for this event is there. Feel free anytime, hop over, http area.us/PIC for Passive Income course. So area.us/PIC. Head over there and register for this workshop at any time. I'm going to be giving you a crazy special deal. We have a limited number of seats, just so you know, for the people that are on the webinar tonight. So you may want to head over there now. So here's the special offer. A live workshop. You get 1 ticket to come to the event. You get a workbook when you come, checklists and calculators, and you get a copy of George's best-selling book, The Wealthy Code. We'll get you hard copies. We'll also get you an ebook version so you can read it right away. You want to read the book before you come to the training is the thing. So read the book before you come to the training, at least the first 6 chapters. Make sure you have that foundational knowledge before you come to the full workshop, okay? So normally we charge $19.97 for this package. Ticket to the workshop, all the things you get when you come, and the book, $19.97. Because of our partnership with Dustin and with Big and with all the different REIAs that Dustin runs, we're able to give you a group and a volume discount. So we're going to offer this to you for any of the members of the club. Actually, for the members is going to be $397. $397 for anybody who's a member. You get all the training, you get the workshop, you get all the workbooks, checklists, calculators, the book for $397. We want to make this as much of a no-brainer for you as possible, obviously. So there's no barrier to entry for you. And what I'll tell you is we only have, because we're doing so many different previews to fill these couple of workshops we have coming up, we can only take a certain number from each that we do, so that this way there's space and room, because we have limited seating at the workshop, obviously. So we can only take 22 of you tonight. So we only have 22 spots available for the folks that are on the webinar tonight. So again, head over to area.us/PIC and get yourself registered. Be one of the first 22 to get this deal, okay? So our money back guarantee. I mean, this is insane what we put together, what George has put together for the money back guarantee, but we stand behind what we do. And here's what it is. If for any reason you are not thrilled and satisfied with the live workshop, let us know at the end of the event, and we'll refund you 100% of your purchase price. Try it out. You have the whole event to decide where it's free. This means you could come to the entire training. We don't ask you to let us know at the end of day 1, come to the whole entire thing. If you're not completely blown away, by the end, let us know at the last second on your way out the door and say, I want my money back. No questions asked. We'll give you your money back. We stand behind what we do, folks. We know that what we do will completely, forever change your life. We've been doing it for years all over the country. Thousands and thousands of investors come through this training. We have never had one single person ask for their money back. And there's a reason for that. But we do back it up. So you have literally nothing to lose by signing up and by registering for the event, and everything to gain. All right, so imagine how you feel having the confidence and muscle memory in structuring safer, more profitable deals. Again, confidence and muscle memory to go out there and know that you know what you're doing, you know how to set things up the right way, you know how to invest your money and other people's money confidently the right way. And muscle memory, because you're going to learn from doing. So you're going to leave with this muscle memory to do it the right way. And what is the cost of not knowing this information? What is the cost of not knowing this? It is huge. It is absolutely through the roof. Again, the examples that I shared, the $1 million that the guy lost of friends and family's money because he didn't know how to structure his deals the right way. A couple of other examples I'll share with you. Investors raised these are real examples, by the way, of people we've met along the way. Investor raised $250,000 from family and friends, invested into rental properties, lost both properties and the family's money. Another investor invested his own money, $128,000 into a deal, and lost it. And that happened to represent most of his life savings. This is happening all the time. Number is way larger than this, obviously. You need to learn how to structure deals the right way, is the bottom line. So you have an important decision to make here tonight. Either continue with this hope and pray approach, bouncing around from different ideas and different strategies, or you come and learn the methodical, scientifically proven, literally, approach of how to do investing and how to structure your capital of your deals the right way, set yourself up for a lifetime of success, a lifetime of abundance. This is the decision you have to make. Continue trying to figure it out, or just come and learn the blueprint. Simple. Come, spend 3 days of your life, learn the blueprint. You have it for the rest of your life. You'll know what you're doing when you leave this event. You'll never question again, is this the right way to do this? Or I don't know, I'm not sure how to structure this loan or this down payment. You will have complete clarity, measuring risk, measuring return, and knowing how to do things the right way. So I love this quote. One of my mentors, Anthony Robbins, says, "It is in your moments of decision that your destiny is shaped." It is in your moments of decision that your destiny is shaped. You know, every single one of us is where we are today because of all the decisions we've made up to this point, without fail. Every one of us is where we are because of the decisions we made leading up to this moment. And we'll be where we are in a year, 5 years, 10 years from now because of decisions we make today and moving forward. So I cannot urge you enough. Make the best decision you can make for your investing career and come and get this knowledge, come and get this training. So again, we have the upcoming workshop, the Passive Income Course. Dustin mentioned these dates, April 13th to the 15th in Atlanta. And then we have another date. I actually literally just put this on the calendar today. So this gives you another option, August 16th to the 18th. So that's Thursday to Saturday in Nashville, Tennessee. The one in Atlanta is Friday to Sunday. So you may want to just jot those down so you're clear. They're also on the, if you go to REIA, again, area.us/PIC, those dates are there as well, I believe. April 13th to the 15th in Atlanta, August 16th to the 18th in Nashville. Again, $397. This is an absolute no-brainer. We're basically giving you the event for cost, really. $397. Come and attend the event. Only 22 spots available for the folks on the webinar tonight. So I will hope to see you all and meet you there, and I'll look forward to when you show up, absolutely blowing your mind with what you'll learn and what this training is. So we bring it to the end here, and I'll just open it up, Dustin, if there's anything you want to add, and I'm happy to stay on for another, as long as we want to stay on and take as many questions as possible and answer people's questions. And, I have time. So Dustin, I'll turn it over to you, my friend. Okay.
Before we take a few questions, I answered most of them, and you did as well throughout the call, but we do have a few. I wanted to remind everybody that you are going to be in Charlotte, North Carolina tomorrow night. It's Charlotte REIA. That's tomorrow night, March the 1st. It's Charlotte REIA. Paul's going to be in Tampa, Florida on Thursday, March the 8th. That's Thursday, March the 8th. That's about a week from now. And then he will be in Atlanta, Georgia on Monday, March the 12th at Atlanta REIA. Monday, March the 12th. So again, that's Charlotte on March 1st, Tampa on March 8th, and Atlanta on March 12th. Get out, see him in person if you get the opportunity, and pick his brain, ask him lots of questions, participate in the interaction that he does with our groups. I think you'll really, really enjoy it. All right. We had at least 2 more questions come in that I wanted to ask you that I wasn't able to answer on your behalf. One was from Jane. And she said, I'm trying to get my head around why an equity partner putting up 50% of the down payment gets 50% ownership. I thought that was a good question that you might want to take on.
That's a great question. So it's not necessarily 50%. So basically the answer is how much they put up as a down payment as far as the percentage doesn't necessarily correlate to what percentage of the deal they get. In other words, if they put up 20% of, for the down payment, that doesn't mean that they get 20% of the deal. It doesn't mean that they get 40% of the deal. They're not necessarily related. And what I'll share with you is, once again, there's only so much that I can teach you tonight as far as how that works. But what I can tell you is this. You'll learn the details at the workshop. Obviously, we're going to give you a lot of details about how to figure that out and how to calculate it. But to give you as much value here tonight as far as understanding how that works is basically related to, you want to make sure that if somebody's investing their money into a deal, number one, that the amount of risk in that deal matches the amount of risk they're comfortable with as an investor. And you have to make sure that that investor is getting, the right amount of return out of the deal. If their investment is $20,000, you have to make sure that their return, their cash flow, what they're getting out of the deal it has to make sense for them to invest the money, right? So there's a whole formula and ways to figure that out that we'll be teaching you in great detail when you come to the live workshop. But hopefully that helps you understand that it's not necessarily a direct relationship to the percentage of money they invest in the deal based on the percentage that they get out of the deal or the percentage of equity in the deal. It's a bit more complex than that, but we're going to teach you and you'll have a full understanding of that after the workshop.
Now, this is my follow-up regarding that question. if they're putting up the down payment, are they taking out the loan for the other 80%?
It's possible, but not necessarily. Typically, if you bring in an equity partner, let's say, they'll put up the down payment, you'll put the loan in your name, or you may bring in another partner that's a credit partner, that has the loan in their name. So there's a lot of different ways that you can do that. So there's not a clear yes or no answer to that question. You may bring in an equity partner that also puts the loan in their name. If they do that, they're obviously taking on a little bit more risk and a little bit more of the responsibility for making the deal happen. So their percentage of the deal would shift and would change based on that. If they're putting up the down payment and not putting the loan in their name, you're putting it in your name, that'll affect things and impact things as well. So there's a number of different ways to set that piece up as far as whose name the loan is in, and how you structure the deal as far as who gets what piece of equity would vary depending on that.
All right. And will you be going into more detail about that at the workshop? How to structure that type of equity partner deal?
Yeah, I mean, we'll be giving a lot of details. We won't go necessarily into all the specifics about, you'll have an understanding from the workshop, I'll say this, of how those components work, how they fit in, and how to make the right decisions for who gets what piece of ownership based on what they're contributing to the deal. So we will go, we'll go into a lot of detail about a lot of the different pieces. And we'll give a significant amount of details about that question that you just asked at the workshop as well.
All right, that's exactly what I was asking. And you said you will be covering. Okay, this next question is from Sophie. She is from Denver, Colorado. So she's not necessarily part of our REIA group, but she's a part of a group out there that some of our friends run.
Right.
She asked, how is this workshop pick different from the membership training module on your finance website?
So which membership training module on the website are you referring to?
She didn't say specifically, but I assume it may be similar to what you've been talking about tonight.
Okay. So what I can tell you is that any training that is live and interactive and in person, this is basically a similar thing to the active learning versus passive learning. It's like, what's the difference between attending this workshop or reading the Wealthy Code book? It's a huge difference in your level of knowledge and understanding that you get from immersing yourself in a training environment for 3 days, going through actual processes and exercises, like literally getting your hands dirty in the training, so to speak, for 3 days straight, versus just consuming some content online, or versus just reading a book. So those all have their place, and they can be, they have their level of effectiveness, but nothing, in my experience, nothing can compare to the experience of attending a live workshop and actually experiencing processes and going through the processes yourself and learning by doing. So I don't know the specific answer to that, because I'm not sure which module or which online training that she's referring to. But what I can tell you this as well is that this is now a new enhanced 3-day version of this training. So we're adding a whole bunch of content, a whole bunch of information that has never been part of this training before. So this is a new 3-day version. We used to do a 2-day version of this training. So there'll be I'm sure there'll be a lot of additional content, a lot of additional information at this workshop than whatever is the module that she went through online as well, in addition to the experiential piece of it.
I'm glad you mentioned that, because you're speaking at several of our REIA groups where people have seen you before and have perhaps attended the Wealthy Code before.
Yep.
Can you give those guys that have attended before, do they need to repeat this? Should they repeat this? And if so, what's going to be different?
Yeah, it's a great question. So my recommendation is, even if it was the same exact training that it was before, I would say come again, and I'll tell you why. When I was first going through this training with George, and I was preparing to teach this class for George when it was the Wealthy Code, when it was a 2-day version, the 4th, 5th time that I went through, it was like I was still getting new insights and new ahas from it. Because of, you'll leave with a really clear understanding after the first time. But going back through and repeating and re-ingraining And where you are in your career and where you are in your journey as an investor and your level of knowledge and understanding, you'll get new and different things going back through the training a second time, a third time. There are some trainings out there I've literally gone through like 7 or 8 times. That's just me. And again, I'm a growth junkie. So,
Absolutely.
that isn't necessarily everybody, but I can tell you that this training, because of how technical it is, and we'll make it where you're able to comprehend it, but it's a relatively advanced training. So you have nothing to lose by repeating it and going back through to refresh, even if it was the same. That being said, it is different. We have added a whole third day. I won't give you the details of what the content of the third day is, but what I can tell you is that the third day is incredibly powerful. It's brand new content that you haven't gotten before if you've been to the Wealthy Code before. That third day, literally by itself, would be worth the entire investment, times 10. So the answer is an absolute yes. If you've attended the Wealthy Code in the past, come and take the passive income course. Get the refresher on the content that'll be repeated, and get the new content and the new information and the new experience from the third day as well.
Well, that's all the questions we have tonight. You got any closing comments you'd like to make, Paul?
I just want to thank everybody for being on tonight. I want to thank you once again, Dustin, for having me on. It's, really, truly my privilege, my honor to do what I do. And it's incredibly fulfilling work. I can't tell you how many people that I've connected with. I was just at an event up in San Jose with one of our more advanced level trainings in San Jose this past weekend. And I ran into, a couple dozen people that I had met when I taught the Wealthy Code, that attended the Wealthy Code. I really can't tell you how fulfilling it is for me to connect with people that went through this training, that we deliver, that I've delivered, and are now having extraordinary success. And the level of fulfillment that I get out of that is something that I really can't describe with words. It's literally why I do what I do. It's why George does what he does. It's why our company exists. I just want to leave everybody with this. We do what we do from a truly heart-centered, mission-driven place to help people create what we call financial happiness. There's financial freedom, most of you have heard of. We use the term financial happiness because it's not, the money is great, but it's not necessarily about the money. We all think it's about the money, but it's actually not, because when I've had this happen, George has had this happen, tons of other people have this happen. They have this number in their head that they think, when I get to that place, when I achieve this level of financial success, I'll be happy. And people get to that place and achieve it and then realize, oh, this isn't what I thought it was going to be. So we teach you how to create financial success with incredibly powerful strategies that we like to call hacking the financial system, literally. What we'll teach you at this event is like hacking the whole system of finance to make it work for you. But it's about happiness. It's about fulfillment. It's about the freedom to do what you want with your time. And that's where we come from in our training. That's why this was created. That's why this was designed. That's why we deliver it. So I really hope that as many of you as possible come to the training, learn the strategies that will completely set your path as an investor on a different track. And we're also going to help you get clear on what is financial happiness for you. What does that look like, right? And make sure you're on a path to achieving that. The community, what we do, what we teach, the experience, the environment we create is literally like nothing else that I've ever experienced. And it's, again, just truly a privilege and an honor for me to do this work, for me to do what I do. And I'll just leave it at that. I hope to see as many of you as possible, meet you in person, and have a chance to really have an impact on your life more than the 90 minutes we were able to spend here tonight. So I will leave it at that, and wish you all incredibly well. Wish you all the success in the world. And I know that we have the ability to help you create that. So I hope you come play with us.
Sounds great, Paul. I really appreciate you being here tonight. And I know everybody at home does as well. Thank you so much, man. We really, really, really appreciate it. And I appreciate everybody else out there tonight that took the time to spend the evening with us. Thank you so much. We look forward to seeing you at a meeting real soon. Paul, I will see you in Tampa, and I will see you in Atlanta in
Great.
Few days, few weeks, my friend.
Awesome. I look forward to it. Thanks again, Dustin.
Thank you so much, my friend. Have a great evening. Good luck tomorrow in Charlotte.
Thank you so much. Good night, everybody.
Good night, everyone. God bless.